Welcome back, and would love to hear your thoughts.
They needed to do this, and they are going to be needing to raise rates through the year. So I think they're finally on the right path. The question is it going to be enough, and is it a little bit too late? Because inflation has already obviously kind of gotten into the system.
So you're in the same camp that we might find Larry Summers in these days, the behind the curve camp, which is the opposite camp from what we just heard from a couple of the market practitioners on our panel. What would you tell people who think the Fed is making a mistake here?
Well, I think it's really important that inflation expectations don't get out of control and become unanchored. And of course, these disruptions associated with the war in the Ukraine, with the lockdowns in China that are going to disrupt supply, other supply disruptions, that's outside of the Fed's direct control. But that doesn't mean that the Fed shouldn't respond to it. People don't care what the source of the inflation is. When they see prices going up, they're going to demand higher wages. And if the Fed's not doing anything about it, they're going to say the Fed doesn't care. And so I want even higher wages because inflation went from under 2 to 8, and it could go to 10.
Randy, how does the Fed thread the needle and go from maybe behind the curve, to use the cliche, to at least equal to where the curve should be? How do they do that without, as the yield curve is telling us, tipping the economy into a recession?
That's always the challenge, because of course they've got to rebuild credibility and make sure that it's not clear that they've lost credibility, maybe a little bit, but make sure not to lose it and build credibility. And saw in the late 70s, Paul Volcker had to raise rates very significantly, unfortunately, tipping the economy into recession. I think with the combination of higher rates and with all the uncertainties of war and sanctions and weighing on investment, weighing on people's consumption, it's tough. And so I think the chance of us tipping into a recession is now reasonably high by the end of the year, beginning of next year.
Let's talk a little bit about the decision not to begin to reduce the Fed's balance sheet at this meeting. That sounds like it is over the next hill. How important is that in, number one, fighting inflation, reducing the amount of money that's in the system? And two, is that, I hesitate to use the word, a more humane way to practice monetary restraint than the more blunt instrument of raising interest rates?
Well, I think they both have to do with the amount of resources and reserves that are in the system, the amount of liquidity that's being put into the system. So they will work through similar means, and both will tighten credit conditions. So I think a reduction of the balance sheet would effectively be putting pressure on interest rates also. So I think the consequence is similar. I think what they wanted to do is start with something more traditional, 25 basis point increase, not a 50 basis point increase. They wanted to signal things are going to move in a direction towards trying to bring rates up. We still have to remember that inflation's at 8%. They expect to be at the end of this year at about 1.75%, 2%. That still means that the inflation-adjusted rate is negative 6%. That's still not very restrictive, but I think they need to do it, and I think they are on that path. And I think the balance sheet reduction will be a complement to that, but I think they're going to more have that in the background rather than use that as a primary tool.